Good afternoon, everybody. It's a pleasure to have a very good friend of our real estate program, Spencer Haber. He is the CEO and chairman of H2 Capital Partners and soon to be the chairman of the Zell Lurie Centers Advisory Board. Spencer, welcome.
Thanks, Chip.
We really appreciate you taking the time. It's our pleasure. We've seen 3 decades plus now of a secular decline in interest rates. It appears that's ending. Who knows if we're going to see a reversal. But when something persists over that many years, that many decades, habits get formed.
Yeah.
What new habits, modes of thought, what do we need to be thinking about both on the credit investor side of the world, your side of the street, and even for borrowers out there? Yeah. What should we be looking for, and what mistakes don't you want to make by doing the same old thing again and again and again?
Yeah, I think the first thing to be aware of is just that we are in uncharted territory, and that being aware that there are things that we'll see in this part of the monetary cycle that none of us has ever seen before. And so I think anybody who tells you that they've got it perfectly charted and perfectly figured out, I'd be scared of that level of confidence. I don't think the Fed thinks that they have it perfectly charted out. And I think I always say it's a little bit like if you took a building and you had a helicopter hover over the building and dumped a giant container of water, on the roof, and you just kept deluging the building with water, you wouldn't really know. I mean, you'd know it's supposed to kind of run down the gutters, and you'd supposed to come over the sides of the walls and nicely empty out into the street. But what you'd probably find is that there's some cracks that you didn't know about, and until you'd actually dump the water on top of the house or on top of the building, it's very hard to see kind of where all the cracks are. And money and capital and the cost of capital are like water. And so from our perspective, it's very hard to understand all the little crevices that 5 or 6 years of risk-seeking behavior and yield-seeking behavior, all of the little crevices in which that's gotten into. I think the primary thing that we would be focused on is the steepening of what I would call the credit curve. And when I say credit curve, I don't just mean in credit assets, but what I mean is the marginal yield or return that one expects from the best asset to the second best asset, all the way down to the worst asset in any asset class in any market. So it could be the Class A building versus the Class B and C building. It could be the Tier 1 global gateway market versus the secondary market versus the tertiary market. It could be the AAA bond versus the BBB bond versus a single B bond. There are an infinite number of credit curves that exist, and I think one can expect that when investors have been motivated to look for yield, reach for yield, that credit curve, the difference in pricing between the best and the worst, has generally compressed in almost every asset class. And by the way, it's not just a real estate phenomenon. This is true in corporate America, in private equity, in venture capital. And one would expect that that curve will steepen. And I would start to look for, as canaries in the coal mine, or perhaps our nominees for canaries in the coal mine, the steepening of credit curves across different asset classes and the beginning of investors starting to say, well, in this environment, I really need to be worried about the music stopping first in the tertiary market, the lower rated bond, the thing that's out the credit curve in whatever asset class we're talking about. And I think the second thing is just thinking about cap rates. And the relationship between interest rates and cap rates is something that I wouldn't pretend to be an expert on academically. I suspect, and I've seen research that various organizations have produced that can prove any point that you would prefer to prove. So if you don't think they're correlated, I can show you a report that says that. If you think that they're positively correlated, which we would tend to, I can show you that report. I'm sure I could find one that shows that they're inversely correlated. That's a little hard to believe, but I'm sure there's one that exists. If you want to know what I suspect, and this is probably a very foolish thing to prognosticate on, but I suspect that with respect to interest rates and market rates, that there is a period of time when interest rates will increase, where almost nothing will happen with cap rates. And as I have said, on occasion, I think the first 100 basis points are probably free. And I don't know whether it's 100 or 50 or 150, but I suspect that the pure weight of money, and that's something not to underestimate, in particular the weight of non-U.S. money, will the farther you are up the credit curve in terms of Tier 1, Class A, gateway, what have you, the safest thing, the store of value thing, I think you'll see a period of time where there will be relatively inelastic moves in pricing for interest rates. And then you'll get to a tipping point. And if I could tell you what basis point number that would be, I would be sitting on a beach somewhere. I'm not smart enough to tell you that, but I do think that we believe in mean reversions. We don't necessarily believe that this time is different is a great way to go about investing. I think a lot of investors, if they were to look at the return attribution of their expected return, IRR, what have you, over an institutional holding period, 5 years, 7 years, 10 years, and said, okay, whatever it is you're investing in, debt, equity, what have you, whatever market, I expect a 7 IRR, a 9 IRR, an 11 IRR. If one were to look at over a 5 to 10 year hold, what the attribution is coming from the reversionary cap rate, the terminal cap rate, how good's your sale going to be, as a percentage of your total return, that's something that would, I think, highlight how important it is not to be overly aggressive, not so much where cap rates are today or a month from now or 3 months from now or when the Fed gets started or 9 months after the Fed gets started, but really the cap rate you care about is the cap rate 5 or 7 years from now. And I think from that perspective, we'd be a little bit concerned about that. And I would tell you that in the last 12 to 18 months, many institutions have seriously thought about how do they start taking some chips off the table. I don't think the more sophisticated institutional investors are unaware of this risk. I think what remains to be seen is how much of it is talked about and strategized about, and how much of it actually makes its way into hard buy, sell, hold decisions before whatever that tipping point is.